It is the weekend, and the silver market is dark. Nothing is trading. No price is moving on your screen. The futures are closed, the dealers are quiet, and if you glanced at silver right now, you would see the exact same number you saw on Friday afternoon, frozen in place, looking like a market that has gone to sleep. But I need you to understand something before that frozen number fools you the way it is fooling almost everyone else this weekend. A closed market is not a quiet market. Some of the most important things that will decide where silver opens on Monday are going to happen in the next 48 hours, while the screen tells you nothing is happening at all. They will happen in a handful of very specific places, none of which are the price chart you keep refreshing. And the financial media that would normally explain it to you is off for the weekend, which means by the time anyone tells you what occurred, the market will already have moved on it. So before that opening bell rings Monday, every single person who owns an ounce of silver needs to see the board clearly. Because when silver opens, it is not going to give you time to think, and it is not going to wait for you to catch up. Stay with me for the next few minutes, and I am going to hand you the entire setup, exactly the way the people who actually move size are looking at it this weekend. Let me start with what Friday left us with, because you need the real picture, not the headline. Silver finished the week sitting in the mid-70s, drifting in a tight, narrow band that it has barely left for days. Most of the coverage I read going into the weekend described that as silver being stuck, range-bound, directionless. And I want you to throw that framing out right now, because it is the most dangerous misread in this entire market. A price that refuses to move inside a band only a few dollars wide is not a market with no opinion. It is a market where two enormous forces are leaning against each other with almost exactly equal weight, and neither one has broken yet. That is not stability, that is compression. It is a coiled spring being wound tighter every single session, and the entire history of markets tells you the same thing about compression. The longer it lasts, the more violent the release. So the right question going into Monday is not, why won't silver move? The right question is, what is squeezing it from both sides, and which side cracks first? Let me show you both sides because that is the whole game this weekend. There are three things that can resolve between now and Monday's open, and any one of them can move silver several percent in the first hour of trading. The first, and the heaviest, is the conflict in the Middle East and what it is doing to oil. For months now, the war and the threat hanging over the Strait of Hormuz, the choke point that a huge share of the world's oil has to pass through, has kept crude elevated. And elevated oil is not just an energy story for silver owners. It is the lever that has been jamming silver's price. There have been signals of de-escalation, of negotiation, of tankers moving again. And each time those signals appear, oil sags and silver tries to lift. And each time the talks wobble, oil climbs back toward its highs and silver gets shoved back down. That tug of war does not stop for the weekend. Diplomacy happens on Saturdays and Sundays. A headline can drop Sunday afternoon while the market is closed, and silver will gap on it the moment the open arrives. So the first variable you are watching is simple. Does the energy picture cool, or does it heat back up before Monday? The second thing that can resolve is the inflation and interest rate signal, because that is the other half of what is holding silver down. Here is the chain, and I want you to really hold it, because once you see it, you will understand why a metal in a structural shortage is somehow sitting at $76 instead of $150. Elevated oil pushes energy costs up. Higher energy costs push the inflation rate up. The most recent reading came in hot, near the highest in years. Hot inflation backs the central bank into a corner where it cannot cut interest rates, and where some of the market is now even betting on a hike before year-end. And when interest rates stay high, holding a metal that pays you nothing becomes more expensive relative to parking money in a bond that does, which strangles the demand for silver as a store of value. So every flicker of data, every comment from the new leadership at the Fed, every shift in what the market expects them to do, feeds straight into silver's price. Any of that can move over the weekend, or in the first data release of the week, and it changes the math for Monday. The third thing is the one that almost nobody is watching, and it is the one I care about most, because it is the one building underneath everything else, regardless of what oil or the Fed does. It is the physical market. While the paper price sits frozen this weekend, the real metal is doing something the chart cannot show you. The amount of physical silver actually available for delivery against the mountain of paper claims sitting on top of it has stretched to a level that should make every holder pay attention. Paper obligations running many times larger than the deliverable metal on hand. And quietly, in the background, that metal has been moving east, where buyers are paying a visible premium over the Western price to get their hands on real bars, because in their market they actually need the physical, and there is not enough of it. That premium is one of the purest signals in the entire silver world. In a healthy market, it would close in days, as traders ship metal from the cheap side to the expensive side and arbitrage it away. The fact that it refuses to close is telling you the metal cannot move fast enough or freely enough to satisfy the demand. That is not a chart pattern. That is a physical shortage speaking through the noise. And it does not take the weekend off either. And here's the part that makes it genuinely dangerous for the people holding paper instead of metal. You do not need everyone to demand delivery to break a market stretched this thin. You only need enough of them. The moment a large enough buyer decides it wants real bars instead of a cash settlement, the exchange has to find that metal somewhere. And if the deliverable pile is thin, it has to bid that silver away from someone else at a higher price in order to hand it over. That is the instant the paper price and the physical price snap violently back together. And it does not unfold politely over months. It can happen in a single session, including the one that starts Monday. So let me walk you through what each of these actually means for Monday's open, because this is where most people stop thinking and just hope. If the energy picture cools over the weekend, if there is genuine, credible progress toward calming the conflict, if oil drops hard, then the single biggest weight pressing on silver lifts. The inflation fear that has frozen the Fed starts to unwind in the market's mind before it even shows up in the data. And silver does not wait for the official numbers to confirm it. It moves the instant the market believes the energy shock is ending. In that scenario, you do not see a polite recovery. You see silver gap up through the resistance it has been failing to break, and the levels that looked like a ceiling all month suddenly become the floor. That is the upside case, and it is real. And understand the asymmetry hiding inside it, because this is the part that matters. Restarting the monetary engine does not just add a few buyers to a normal market. It adds a wave of fresh monetary demand on top of a market that is already physically short, already drained, already running a structural deficit. That is how you get a move that does not politely stop at the obvious target. The kind of repricing where the physical reality that was being suppressed all month becomes the price all at once. And silver travels from the mid-70s into the 90s in a matter of weeks, instead of taking one tidy step higher. Now here is the side nobody wants to model, honestly. And I'm going to give it to you straight because you deserve the truth and not a sales pitch. If the talks collapse over the weekend, if the conflict escalates again, if oil rips back toward its highs, then the pressure on silver gets worse before it gets better. The inflation fear deepens, the odds of the central bank staying aggressive climb, and silver could get pushed down to test the support that has been holding beneath it. It could open Monday lower, not higher. Anyone who tells you silver can only go up from here is either lying to you or selling you something. The short term is genuinely two-sided, and it hinges on variables that no one watching this, including me, can control. And the third possibility, which is honestly the most likely one of all given how many times this story has cycled between hope and disappointment already, is that the weekend produces nothing decisive. In that case, Monday opens roughly where Friday closed, the spring stays wound, the compression continues, and the market goes back to waiting for the next catalyst. Up, down, or sideways into more tension. Those are your three doors, and which one opens depends on the next 48 hours. But here is why none of those short-term doors actually change the bigger picture, and this is the part I most need you to understand as someone who holds this metal. Silver runs on two engines. The first is the monetary engine. Silver's role is hard money, a store of value, the thing people run to when the dollar weakens and real interest rates fall and inflation eats their savings. The second is the industrial engine, the relentless physical demand from the real economy. Right now, the monetary engine has been forcibly shut off by the macro picture I just described. High rates and inflation fear are holding it down. That is the entire reason the price looks weak. But the industrial engine has never stopped running, not for a single day of this. And that is the thing the frozen chart is hiding from you. Let me show you that second engine, because it is the foundation everything else is standing on. For years on end now, not one freak year but consecutive years, the world has used more silver than it has produced. The market has run a real physical deficit year after year, draining down the world's accessible stockpiles to cover the gap. And the cumulative shortfall over the last several years runs into the hundreds of millions of ounces. And the brutal part, the part that makes this different from almost any other commodity, is that the supply cannot simply respond to a higher price. Most of the world's silver is not mined on purpose. It comes up as a byproduct of mining copper and zinc and lead, which means even if silver doubled tomorrow, a mining company cannot just decide to dig up more of it. Their silver output is chained to demand for entirely different metals. New primary silver mines take close to a decade to bring online. Recycling helps a little at the edges and cannot come close to closing a structural gap of this size. So the supply is effectively stuck. Meanwhile, the demand is the opposite of stuck. Every solar panel installed pulls real ounces out of that already starved market and buries them on a rooftop where they never come back. Electric vehicles need it. The rebuilding of electrical grids needs it. And the hungriest new consumer of all is the explosion of artificial intelligence data centers, the servers and the power infrastructure to run them, all of which rely on silver because it is the most electrically conductive metal we have, and there is no clean substitute at scale. So you have demand structurally climbing for reasons that have nothing to do with whether silver is in fashion this month, smashing into a supply base that physically cannot answer, on top of a paper market with far more claims than metal. That is not my opinion. That is the structure. And it is the engine that keeps running while the chart pretends to sleep. Now let me show you the math behind the big numbers, because I never want you taking a target on faith, not mine, not anyone's. One of the cleanest ways the professionals frame silver's upside is through its ratio to gold, how many ounces of silver it takes to buy 1 ounce of gold. In quiet times, that ratio is wide, meaning silver is cheap relative to gold, which is exactly where we are now, with the ratio sitting around 60. But at the explosive peaks of past precious metals bull markets, that ratio has compressed dramatically, sometimes into the 30s. Now do the simple exercise. Take the gold price targets the biggest institutions on Wall Street are already publishing, targets well above where gold trades today, and apply a ratio compression anywhere near what we have seen at past peaks. The implied silver price does not land in the 80s or 90s. It lands deep in the triple digits, with some of the most aggressive desks publishing silver ranges that climb past $200. The point is not that any single figure is a promise. The point is that the largest and most conservative institutions in the world are quietly modeling a silver price multiples above where it sits this frozen weekend. And they are doing it on the same supply and demand structure I just walked you through, not on hype. The shocking targets are not the fantasy here. The flat price tonight is the anomaly. And if this pattern feels familiar, it should, because silver has done a version of it before. Anyone who lived through the last great precious metals run will tell you the same story every time. Silver spent long, maddening stretches looking completely dead, drifting sideways while patient money quietly accumulated, right up until the moment it didn't. And then it traveled further in months than it had in years, and everyone who waited for the move to become obvious ended up buying the top from the people who had calmly bought the boredom. Markets rhyme because human behavior rhymes. The crowd always demands proof before it acts, and in a thin physical market, the proof is the very thing that prices the crowd out. The reward in this metal has never once gone to the people who waited for the green candle to give them permission. It has always gone to the people who understood the setup while everyone else was still calling it boring. And Monday's open is only the first gate. Look at what is stacked up behind it, because this is the schedule that defines silver's next several weeks. There is fresh growth and jobs data due in the days right after the open, and weak growth landing on top of hot inflation is the textbook definition of stagflation, the exact trap that makes the Fed's job impossible and leaves silver pinned between its two engines. Then comes the main event, the Fed's next policy meeting, with an updated set of projections that will reveal whether the people setting interest rates are leaning toward cutting or toward hiking from here. If even a few of them tilt toward cuts, that is the first real signal the monetary engine is about to switch back on, and silver gets immediate relief. If the hawks hold the line, the ceiling stays intact through the summer, and the compression keeps building. Every one of those dates is a fork in the road, and Monday's open is simply the first one you are going to see. So let me be completely honest with you about what you can and cannot control, because that is the only thing on this whole subject actually worth your time. You cannot control what happens over the weekend. You cannot control the headlines out of the Middle East, or what the next inflation print says, or what the Fed decides at its next meeting, or where exactly silver opens Monday morning. Nothing I am telling you is a recommendation about what you personally should do with your money. That decision is entirely yours, and you should do your own homework and talk to people you trust before you act on anything you hear from anyone, including me. The short-term path genuinely could open higher or lower, and the people who panic and dump their silver into the quiet are almost always the same people who never understood what they were holding in the first place. They were watching the number. What you can control is whether you understand the structure underneath it before Monday arrives, and that is the entire reason I made you sit through all of this. So let me remind you, plainly, what you actually own, because I do not think enough holders ever stop and say it out loud. You own a metal that the world has consumed faster than it has produced for years on end, with no quick fix to the supply anywhere in sight. You own a metal whose supply cannot be ramped no matter how high the price climbs, because most of it only comes out of the ground as an afterthought to mining other things. You own a metal that the fastest growing industries on the planet, solar, electric vehicles, the entire build-out of artificial intelligence, physically cannot function without, and for which there is no substitute at scale. You own a metal where the paper claims floating around vastly outnumber the real ounces standing behind them. You own a metal that one of the world's largest suppliers is now actively keeping for itself. And you own a metal that is running on only one of its two engines right now, with the second one not broken, just temporarily switched off, waiting for the macro pressure to lift. When you lay it out like that, the question stops being, why is silver so weak going into Monday? The question becomes, how on earth is silver still this cheap? And the answer is simply that the whole crowd is staring at the one number that is being held down, while everything beneath it tightens. That is what every silver owner needs to see before the market opens. Not a rumor, not a leaked document, something far more powerful than either. A structural setup hiding in plain sight, dressed up as a sleepy weekend, while the people who can read it position themselves before the rest of the market figures out what it was looking at. Deficits do not stay buried forever. Compressed markets do not stay compressed forever, and engines that have been switched off do not stay off forever. The only real question is whether you understand what is happening before the price tells you, or after, and after is always more expensive. Here is what I want you to do with the next 48 hours. Watch the headlines out of the Middle East, because the energy picture is the trigger. Watch where oil is trading when the futures reopen Sunday evening. Watch the first piece of inflation or jobs data that lands this week, because it tells the Fed's hand. And watch the open itself Monday morning, because the way silver behaves in that first hour will tell you which of the three doors the weekend opened. I'm going to be tracking every one of those signals: the energy moves, the physical premiums, the vault numbers, the macro data. And I will break down each one in plain language the moment it actually matters, not a week later when it is already priced in. So if you own silver, or you are seriously thinking about it, subscribe and stay close, because this is not a story that hands you a warning before it moves. And if this gave you a clearer picture of the board than the weekend headlines did, send it to one other silver owner you know. They are staring at the same frozen chart you were a few minutes ago, and they deserve to walk into Monday seeing what is underneath it too. Watch the structure, not just the number. That is the entire game from here. I will see you on the other side of Monday's open.